Guys, please introduce yourself. Let's start with.
My name is Jeremy Ford. I'm the managing partner at Manette Capital. I come from a real estate background and about 7 years move over to the tech side. I was based in London with Carlyle and managed a real estate portfolio across the continent. Got involved with a startup in 2017 that we grew from about 15 people to 15,000 people. So bring the scaling and operational experience, and then went back to the investment side and joined a large real estate investment manager to build out their innovation team focused on investing in technologies for the built world. And so today I'm going to be focusing on family offices and their real estate holdings and how they can leverage technology to drive efficiency.
So I'm David Tedden, and I will give a little bit of context on my intersection of the family office world on several layers. First, I want to give a shout out to my colleague Raphael. Raphael, can you raise your hand? He's about a foot taller than I am, so if you don't catch me afterward, look for Raphael Leopold, but maybe he went out to the bathroom. Brief background, my grandfather, Bernard Davis, co-founded Ziff Davis, which became ZDNet, which became a conference company, media company in tech. So some of you might know it's the same family that also is sort of indirectly became Oxif, or the backers of Oxif. So I grew up with some connectivity in that ecosystem. I was originally an investment banker and strategy consultant, and then a serial entrepreneur in Israel, where I lived for 3 years, in the US, founded 3 companies, sold 2, shut down 1. And then I became a serial builder of VC organizations. I founded HPS Angels New York, which is now the biggest angel group on the East Coast. I joined FF Venture Capital, which is founded by a former Goldman Sachs exec with his own money, and became an institutional VC, 10 million AUM when I joined, now north of 300 mil. And then I joined Hoff Capital as a managing partner, anchored by the Sawiris family of Egypt, which is the dominant business family of Egypt, multi-billion-dollar family office, with very close ties to that family. I joined when the firm was just getting off the ground with single-digit million AUM, and Hoff is now over 1.2 billion AUM with LPs from 37 countries. I now work with Coolwater Capital, and we are Y Combinator for VC funds. We finance, train emerging VC managers. We have graduated 226 VCs, which have collectively raised over $2 billion. Many of them are anchored by, started by next gens, or have, deep ties with some family. So there's a lot of connectivity in that ecosystem. I also run 2 communities that might be relevant for many of you, PEVCtech.com. We run events and publish research around how investors in the private markets can generate alpha through AI technology and analytics. We have particular interest in family office tech, because they think family offices are like hedge funds 20 years ago. They're this emerging category in finance, and they have their own unique needs, and the service providers that address those needs will thrive. And lastly, I run foundersnextmove.com, which is a community for tech founders in transition.
Okay, hi everybody. I'm Marjan Kavantari. My background, very briefly, I've been a startup entrepreneur. I raised 1 VC fund in the Nordics, north of 60 million USD. Worked also previously in large-scale private equity fundraising. We raised funds from both individual investors and institutional investors from Europe and Scandinavia to US. We worked very closely with Hamilton Lane and KKR, even had a close collaboration with Blackstone. We raised, in a very short time period, we raised almost 1.5 billion USD, also mainly from family offices. Now, our family background is in construction and real estate. I'm involved in 2 family offices myself, and my business partner is representing one of the largest family offices in the Nordics. And now we're building our next fund together. So very excited to be here and very honored to be in this panel.
Yeah, my name is Manana, and our family office is and money coming from the oil and gas and airlines too. And they invest in Telegram, they invest in Ethereum. It was $8 with my family, and my concern is because my father, he's passed away, and it was like so extremely how the money come into the next generation. And I was in Dallas more than 10 years, and it's like a specific social impact. Plus, I have a PhD in math, and I was host on MTV. And my passion is AI, and this is why I started investing in AI 2 years ago. And I was more than 2 years, like a quantum trader on Renaissance, like the hedge fund 2 person. And this is why probably my first question is, there is a 10x for the family offices, and like they should be, like the best specifically trends for the next 6 years. What do you think? Let's start.
In terms of how family offices will evolve,
Yes.
well, first we see much greater sophistication in terms of how they're thinking about investing, both in terms of staffing as well as strategies. And so there is a big influx from traditional private equity firms into family offices. And we see them as being an interesting source of capital because they can be more flexible, they can move quicker, and they have the ability to invest in strategies that other firms might take a little bit longer to get comfortable with. That said, there is the intimacy, I guess we could say, of getting to know the families, because it is very personal in how they interact, and understanding the engagement with these groups is extremely important, and building the relationships takes a considerable amount of time. And so while they are quicker to pull the trigger on certain strategies, there is a period where you need to allow for the relationships to be built and the trust, because it is not an institution simply going to an investment committee and saying, let's proceed with an investment.
David, what do you think?
So I think, let's go to the definition of family office. I'd say there are 3 tests of a real family office as opposed to a person with a family and an office, which is not the same thing. So the first is, are you treating the management of your assets like a business? Like everyone in this room has some savings, hopefully, right? You have an E-Trade account, but are you thinking about it as a business in and of itself and applying to it the rigor that you would apply if you were CEO of a company? Point 2 is, do you have your own staff, right? If not, you're a wealthy person with some service providers, which is fine. There's nothing wrong with it. I know of a well-known Silicon Valley billionaire who fired his family office, and he had like dozens of staff, fired them all, went to Morgan Stanley and said, I don't want to deal with this. You manage it, right? That's a totally legitimate option. If you don't want the customization, the control, and so on, you just want someone else to deal with it, and you want to go golf or do whatever. And then point 3 is, you just like any business, you need to take seriously the technology, the analytics you're using to manage your assets, right? The richest person in New York did not make his money by investing. Mike Bloomberg made it by selling picks and shovels to the rest of us, which is why I'm so excited about investment tech, the tools that help investors generate alpha. So if you are a principal family office, you should be thinking about your toolkit in a sophisticated way, just like the manager of this real estate development, right, thinks very seriously about what they use to build it, to manage it, to handle lighting, all that.
Yeah. Totally agree on those 2 points. Building the trust with family offices is a long-term game, and many family offices, of course, are quicker, but they are also more patient capital, so they can take risks that probably more institutional investors cannot take in certain cases. But I think this, like a couple of very important topics that were brought up here. If you look at the most successful family offices in the Nordics and in the Europe, they have had tremendous talent and also probably luck, but how they have integrated professional management to the daily operations and management of the family office. So if you look at the most successful and largest family offices in the Nordics and Europe, they have created a great hybrid between family involvement and professional management involvement on every level, from board to the management team in those family offices. So I would highlight that as a very important thing. Of course, depending on the size of your family office, as you pointed out very well. But if you have a large-scale family office, finding that integration, and because family businesses are hard, right? There are always emotions involved. There are always family members not suitable for running the investments or the family operations. So finding that balance and building that professional management team and creating those incentives that management team actually is aligned with the family's long-term interests, also as shareholders, for example, as shareholders in the business, is super important. And if you look at, you mentioned family offices as a very interesting player in the private equity markets. If we look at the private equity markets, we have the public wealth and we have the private wealth globally, X trillions, I don't remember the exact amount. But if you look at the PE and VC allocations of the so-called public money, the institutional money, that's already very well allocated in private equity and venture capital in all the sectors, including real estate. But if you ask the big boys, if you ask Blackstone, if you ask Hamilton Lane, if you ask KKR, where does the next wave and trend of private equity come from? It comes from private money, from private wealth globally, from family offices and high net worth individuals, because that pot is actually as big on global terms as the institutional pot. And many people don't think about it that way, but that's actually as big as a pool, and it's not allocated as efficiently in private equity. So that's going to be an interesting opportunity.
Mm-hmm. And next question, what do you think you challenge right now?
For family offices?
And how it's like how the landscape look like? There is the benchmarks, it was our conversation before, venture capital plus family offices. How it can be like the best synergy. And plus like your personal challenge.
So we've seen a huge correction over the past couple of years with a change in valuation. And so people tend to be more trigger shy in this sort of environment. And as I'm sure you guys will agree, entry point plays a very big role when making new investments. And so right now we're facing the hangover from the VC correction, but looking at lower valuations now and attractive entry points and the opportunity to have more say in how the terms of new investments can be made. So from the startup perspective, it's less attractive, but from an investor perspective, you always want to be thinking about, am I entering the market at a good time? And so I think one of the challenges in working with families is people will have invested at the peak of the market. They will be looking at valuations of where their current portfolio sits, but they need to understand the importance of investing through the cycle, because it's similar to taking dividends for stocks and things of that nature. You see the greatest appreciation through those dividend investments as markets recover. And while we're still seeing a lot of changes in valuation or write-downs in valuation, companies that are not going to survive through this cycle, there will be winners. And so having partners that are able to look at companies, assess the value of these businesses, in my particular case, having the ability to demo and pilot solutions and understand the broader applicability of technology to the real estate industry should pay dividends.
So I'd say the biggest challenge we as a firm have, and the 226 VCs we work with, some of which are in the room today, have, is the unfortunate intersection of two curves, which I thought as a PhD in math you'll appreciate. So the first is the VC industry has been cyclical since inception, right? Very, very clear when you look at the data. And we're in this trough right now where people went crazy in 2021-ish and threw a lot of money at some really dumb stuff. Right? And we're still dealing with the fall off of that. And the number of people who work in VC is in the process of shrinking by, I would guess, about 50%, right, from peak to trough. That creates a lot of pain, LPs who are burnt, VCs who are leaving the industry, et cetera. At the same time, technology, you could define it as anything that expands human potential. And with modern AI and other tools, right, what one human can do just keeps going up, right? It's an exponential curve, which is why Sam Altman and many others said we're getting to a point where you will expect to see one-person unicorns, right? We've already had, I think, 22-person unicorns, I believe WhatsApp had when they exited, right? So that is insane in terms of the return on your investment if you invest in one of these high-potential companies. And so people don't quite appreciate that enormous opportunity. We're getting this weird dynamic where people are throwing money into SPVs of X.AI, right? Because they see it as the hot thing, which I don't recommend. But at the same time, my view is for the people who are standing and have capital to deploy, this is an exceptional opportunity to get amazing returns. Yeah. But you're fighting all of the blood in the water. I'll just close. When I was in business school, I remember reading Warren Buffett, and he said you should invest from this blood in the water. And I thought, oh, gee, investing is really easy. Like you wait for a downturn, you have a little cash, and then you invest. And now that I'm out of business school, I realize, oh, it's your blood in the water. And so it's much harder to execute that thesis, right, when you and your colleagues and your LPs are bleeding and you have to still deploy new capital.
Yeah, okay. Many of the points were already taken, but maybe to summarize the risk and challenges for family offices. Increasing sophistication with the strategies, how to integrate that to your family office's operations, including new technologies that will enhance your investment operations, including AI. Like, that's a big challenge for family offices, how to handle that sophistication without creating too much complexity in your portfolio, because many family office members are not professional investors, and of course they can bring that professional investment capabilities through the management, but investing is also an emotional game. And if you have strong family members who invest emotionally, that can create challenges for the family office, especially when that portfolio becomes more sophisticated. But totally agree on that, what Warren Buffett, one of my favorite guys, he always says that when others are greedy, be fearful, and when others are fearful, be greedy. I totally agree. Like, now, if you have dry powder, it's a fantastic time to allocate money. But people don't think that. Everybody's focusing on the high interest rates, that they got their ass kicked during the past 2 years with their investments. But if you have dry powder, it's an excellent time to work, especially with your tactical allocation in the secondary market. Find great deals from the candy stores. I think people should be more optimistic about it, and the interest rates will come down. The market will balance, even out. But please remember, it's a great time to invest. It's a tough environment to raise capital, but if you have capital allocated, there are great deals with discounts on the secondary market. Yeah.
Okay, before we go to the next panel about biotech, guys, probably you have questions for our panelists.
It's like a Finnish Nordic audience, yeah.
Well, I have a question. I have a question for the audience.
Yeah.
In terms of investing right now from family offices, people who are here, have you been investing, or has it been more challenging over the past 6 months? Have there, and what sectors have you been investing in?
VC.
VC?
Yeah. Private credit going into those.
Private. Yeah.
What type of VC?
Like early stage, new funds.
New funds. Okay. Private credit. I was expecting to hear that because that is definitely a very popular topic right now from the defensibility of the sector with the corresponding returns for what it is offering. And we didn't really touch on that since we tend to be looking at the higher risk end of the spectrum.
Yeah.
Please.
Just on that, I mean, this topic is on VC and, really, phenomenal growth. Why would you be so enthused on private credit, with the exception of downside protection? Where are you going to get that alpha upside?
Well, it's a question of asset allocation in terms of what the risk-adjusted returns are from the private credit perspective. And so right now, with interest rates where they are and where people are able to lend, and the lack of more traditional credit sources, it provides a great baseline and a very consistent return. But your point is one that is important for the VC world, because there is the lack of that super upside return. It's just, as we said, people have been burned, and so they're more hesitant, and they say, well, if I can get 12% or double-digit returns from a private credit investment, that's one way of generating wealth over the long term.
Hi, Chia Chevet, Managing Partner of Chevet Capital. Thank you for taking the time out to connect today with us. So I have a tactical question and more of a question that's centered around storytelling, which I love. So the tactical question, I've been to a number of family office events, and they're not all created equal. There's varying levels of connection that you can actually make with those that are in attendance. And so I'm curious to know if there are any family office events that you've attended that you found particularly kind of more meaningful or more effective than others, and are there any themes that you're currently looking at from an investment perspective in venture capital? And then the storytelling questions, I'd just love to learn more about, maybe you can share the story of the last VC or family office that you've connected with, maybe chat a bit more, like talk a bit more about how you met them, how you connected, or, anything that you think would be worthwhile for this audience, but more from like a storytelling perspective.
So we coach our GPs on this exact topic. So I'll share with you some of the patterns that we recommend. First off, Groucho Marx said he would never join a club that would have him as a member. So that is how you should think about fundraising. You ideally want to be in a room where you're the poorest person with the least dry powder, and you have to figure out how do you get into that room. So the best way to do it is if you are out fundraising, I know there are quite a few people in this room who are fundraising. We manage outside capital, like we're also meeting with LPs. The worst, most inefficient way to do it is to go around New York City having coffees with random people, right? It'll take you forever. You're inevitably going to get rejected a lot. Very, very inefficient. So the better way to do it is figure out ways to create an event, something online or some content or an in-person event around your particular thesis, whatever it is you do. And so, for example, I'm organizing an event on October 9th with the HBS Club in New York on GP Seeders, because that's what we do at Coolwater Capital. And we're going to get about 100 Harvard Business School grads who are GP Seeders, GP Stakers, are in that ecosystem. And those are all people with whom I have some affinity, right, because we went to the same school and they're interested in my thesis. And that's more efficient than me having coffees with a bunch of people who may or may not be interested in my thesis. So I encourage you to think about your differentiation. And if you tell me we're generalist fund, we invest in anything, that is not, generally speaking, a good way to raise money. I'm sure you have something better than that to say. And whatever you do, organize something around that and get people to it. So secondly is New York City is full of people who pose as something other than they are not. It's sort of part of the literature of New York City. And so always do your DD, like who's selling what to whom, particularly before you buy them dinner. So that you don't waste your time. And it's totally fine to me. People want to sell you stuff, right? I buy stuff. But it's always good to go in knowing that so that you have expectations at the right level and don't fly to Italy for a meeting with someone who's trying to sell you something instead of the other way around.
Yeah, to answer your question, so we are investing. We have invested almost 30 companies in AI during this year. The way we deal with partners, we do the capital call over 8 times, 4 years. So that's the thing we do, and it's pretty good, pretty successful. The question is from LP's perspective, what's your key request in terms of, in addition to the return on investment, right? You want more transparency, you want more co-investment opportunities,
Or social impact.
Yeah, or you want your kids to be an intern or a job.
I think this relates to the other question, and I try to make it as a storytelling question. One of my previous gigs in life was to do very large-scale private equity fundraising from foundations, family offices, very high net worth individuals in Europe. And it was a lot about creating. I'm actually going to answer 2 questions here now. The first one was, how do you meet people? I would say that I think it seems that the American way is to organize large events and get people there. I think, based on my experience, the best discussions were always way, way more private settings, as you said about the club thing. And that comes back to what you said about building trust. So building that network of trust who creates those opportunities, and not those big clubs, but they're much more subtle private settings where you actually make those beautiful and most meaningful connections, I would say, based on my experience. This comes back to your question. I met a very large Nordic family office who had just sold their core business. They have several hundreds of millions of euros to allocate, and it was a father and 2 daughters. And there's a generational dynamic. The father is very old school, and the daughters are very liberal and proactive and want to see a lot of sustainable and concrete impact in how they use the money. So I think that one trend that you can actually see in family offices is people, especially when we have this great wealth transfer going on in the world. So millennials inheriting what the baby boomers created. So that wealth transfer will be one of the biggest in recent hundreds years. Like, it will be a massive wealth transfer that is happening right now. And when you talk with the family office representatives of that younger generation, of my generation and younger, they want to see that those investments provide good returns, but they also provide very concrete, measurable impact in addition to those ESG metrics that sometimes work, sometimes don't. But they want to see on like even on a tonnage level, if we invest in this green tech company, how much on tonnage level per year can our investment save CO2 emissions? So you have to take that. If you want to be successful in fundraising with family offices, you have to take that impact, what you can, and transparency to that level. Don't just show them, excuse my French, bullshit ESG like codes and we do this and we're part of this certification. Show them concrete results that can be achieved if the investment and project is successful. I would say that's very important, probably to your storytelling question. And I was surprised that nobody mentioned energy transition and infrastructure, because if you look at the big companies again, there's a massive, because because the ones who own the infrastructure will own the world, even with AI. And if you look at NVIDIA and all the companies behind NVIDIA in much deeper layers in the infrastructure, and if you look at what, for example, Blackstone is doing now, they've already allocated 50 billion to data centers, and they will allocate another 50 billion to data centers because cloud computing and AI computing needs massive amounts of infrastructure to run that computing power globally. So I think what family offices should think about is how to go from incremental investing to actually controlling the infrastructure with your long-term private equity and venture capital bets. That's my take.
Okay, thank you so much. Guys, yeah, and let's move to the biotech.